This is the second part of the presentation for Chapter 13, Current Liabilities and Contingencies. In this learning objective, we will explain the accounting for gain and loss contingencies. Not all circumstances affecting the company are completely settled at the time the financial statements are issued. For example, contingencies involve uncertain conditions at the balance sheet date that will be determined at a future date. Contingencies can result in possible gains or losses. We will learn how to determine whether these contingencies need to be recorded in the financial statements, disclosed in the notes, or just ignored. Gain contingencies can result from situations such as those listed on this slide. Gain contingencies are not recorded under GAAP, and they are only disclosed if the probability of receipt is very high. This is consistent with the conservatism principle. Loss contingencies are recorded under certain circumstances. The first test that is applied to the contingency is the probability of the loss occurring. The 3 degrees of probability range from probable, reasonably possible, to remote. This slide illustrates when loss contingencies are accrued, disclosed, or ignored. If it is probable that the loss will occur and the amount can be reasonably estimated, the loss should be accrued. If it is probable that the loss will occur, but the amount cannot be reasonably estimated, then the contingency should only be disclosed. If the probability of loss is only reasonably possible, then the contingency should only be disclosed, regardless of whether the loss can be estimated or not. Last, if the possibility of the loss is remote, then the contingency should be ignored. If Scorsese Inc. is involved in a lawsuit at December 31, 2020, and it is probable that the company will be liable for $900,000 as a result of the suit, then a journal entry is appropriate and a loss should be debited and a liability credited for the $900,000. However, if it is not probable that Scorsese will be liable for any payment, then no entry is necessary. It may be necessary to disclose the information in the notes if the loss is reasonably possible. 3 examples of loss contingencies that are usually accrued are bad debts expenses related to the collectability of receivables, obligations related to product warranties and product defects, and premiums offered to customers. The reason that these are usually accrued is because the losses are probable and the amounts are reasonably estimated. This slide shows some examples of losses that are usually not accrued. One reason is that these conditions do not meet the definition of a liability. If you remember from the first presentation, a liability results from a past event. Although these are conditions that may result in losses in the future, if there is no past event that has already occurred, then there is no recognition of a loss. This slide shows some of the types of losses that may or may not result in the recording of a loss. The recognition or disclosure would depend on the probability of the loss as well as whether the amount can be reasonably estimated. When the loss is probable, but only a range of the loss can be estimated, GAAP requires that the lower amount of the range be recorded and the entire range be disclosed in the notes. If you are unfamiliar with the term expropriation of assets, this means that the company's assets usually located in a foreign country are taken over by the government of that country. This slide shows 2 additional loss contingencies that may be recorded or disclosed. It is important to note that the guarantees of indebtedness on the previous slide, as well as both of the contingencies listed on this slide, must be disclosed even if the probability of loss is remote. These 3 are exceptions to the rule that losses that are remote are ignored. Obligations of commercial banks under standby letters of credit refers to assurances given by the financial institution to companies that they have the backing of the financial institution when engaging in a business transaction. The agreements to repurchase receivables occurs when a company sells receivables to a factor with recourse. With recourse means that if the debtor who owes the money does not pay the factor, then the company will reimburse the factor. Now, we will discuss 4 of the most common loss contingencies: litigations, claims and assessments, guarantee and warranty costs, premiums and coupons, and environmental liabilities in more detail. When considering loss contingencies from lawsuits, claims, and assessments, the company, with the help of their legal counsel, will have to determine first if there is a past event that has already occurred, as well as the probability of the loss, and whether the amount can be reasonably estimated. As we saw in the previous Scorsese examples, the loss must be probable, and the amount reasonably estimated for the liability to be recorded. Otherwise, disclosure of the loss may be appropriate, or if the probability of loss is remote, then the contingency is not recorded or disclosed. Companies frequently include warranties with products that they sell to consumers to make good if there is a defect in the product. There are 2 types of warranties. One type is an assurance type warranty that comes with the product when it is purchased. This is the manufacturer's warranty included for no additional charges when the product is sold. The second type of warranty is called a service type warranty, and it is sold separately to the consumer for an additional fee to provide service after the manufacturer's or assurance type warranty has expired. The assurance type warranty included with the product means that the product will meet the agreed upon specifications in the contract at the time the product is sold. Under the matching principle, the expense associated with the assurance type warranty should be estimated and recorded in the same period as the sale, and the associated warranty liability should also be recorded in the same period. To illustrate an assurance type warranty, we will consider the case of Denson Machinery Company. Denson sold 100 new machines for $5,000 each in July 2020 for a total of $500,000. Each of the machines carries a 1-year warranty, and based on experience, Denson expects they will have $200 of warranty expense for each of the machines, for a total of $20,000 over the 1-year warranty period. During 2020, Denson performed repairs costing $4,000 on the machines sold, and in 2021 performed repairs of $16,000. To record the sale of the machines, Denson would debit cash and credit sales revenue for $500,000. As the machines are repaired, Denson would debit warranty expense and credit various accounts such as those shown for $4,000 depending on the type of repairs performed. At the end of 2020, Denson would accrue the remaining warranty expense of $16,000 by debiting warranty expense and crediting warranty liability for $16,000. At December 31st, 2020, the balance sheet would show the $16,000 of warranty liability, and the income statement would report $500,000 of sales revenue and the entire warranty expense associated with the machines of $20,000. In 2021, as the machines are repaired, Denson would debit warranty liability for $16,000 and credit the various accounts according to the repairs made. At the end of 2021, no warranty liability would remain for the machines sold in 2020. Service type warranties are sold to provide additional service beyond the assurance type warranty. These warranties are recorded as a separate performance liability and usually are recorded as unearned warranty revenue initially. After the assurance type warranty has expired, the service type warranty revenue will be recorded. usually on a straight line basis over the warranty period. To illustrate a service type warranty, we will consider the sale by Hamlin Auto of an automobile for $30,000 on January 2nd, 2020. Hamlin estimates the assurance type warranty cost to be $700 over the 3-year, 36,000-mile warranty period. The customer also purchases a service type warranty for $900 that will cover the automobile for an additional 3 years beyond the original warranty period. Hamlin incurs warranty costs related to the assurance type warranty of $500 in 2020 and $200 in 2021. Hamlin records the revenue on the service type warranty on a straight line basis. In the next slides, we will make the entries for these transactions for 2020 and 2021. To record the sale of the automobile, Hamlin would debit cash for $30,900 and credit unearned revenue for $900 for the service type warranty and credit sales revenue for $30,000 for the automobile. To record the warranty repairs under the assurance type warranty for 2020, Hamlin would debit warranty expense and credit various accounts for $500. At the end of 2020, Hamlin would make an adjusting entry to record the remaining warranty expense that they expect to pay in 2021. This entry would be a debit to warranty expense and a credit to warranty liability for $200. The balance sheet would reflect the warranty liability of $200 and the income statement would report the $30,000 of sales revenue and warranty expense of $700. After the 3-year, 36,000-mile warranty has expired, Hamlin would begin to recognize the warranty revenue for the service type warranty. To record the warranty revenue in 2023 through 2025, Hamlin would debit unearned warranty revenue and credit warranty revenue each year for $300 or 1/3 of the total revenue of $900. The warranty costs associated with the service type warranty would be expensed as they occur in the 3 years that the warranty is in effect. Now we will discuss consideration payable, which is another type of loss contingency that is accrued. Companies frequently offer incentives to their customers to purchase the company's products, such as premiums, coupons, and rebates. Under the matching principle, the cost of the consideration payable should be recorded in the period of the sale. Some costs are recorded in the same period as the sale, but usually there is a need to record an estimate of the remaining expense that will be paid in a future period. To record the entry, the company would charge the remaining cost of the premiums to premium expense and credit a premium liability. To illustrate the recording of premiums, we will consider the case of Fluffy Cake Mix that sells boxes of cake mix for $3 per box. Fluffy offers its customers a large, durable mixing bowl in exchange for $1 and 10 box tops. The mixing bowls cost Fluffy $2, and the company estimates that customers will ultimately redeem 60% of the box tops. The premium offer began in June 2020, and during 2020, Fluffy purchased 20,000 mixing bowls at $2 per bowl and sold 300,000 boxes of cake mix for $3 per box. A total of 60,000 box tops were redeemed in 2020, and the first journal entry Fluffy would record would be the purchase of the 20,000 mixing bowls for $2 per bowl. To record the entry, Fluffy would debit premium inventory for $40,000 and credit cash for the same amount. To record the sale of the cake mixes in 2020, Fluffy would debit cash and credit sales revenue for $900,000. To record the redemption of the 60,000 box tops in 2020 and receipt of $1 per 10 box tops, Fluffy would debit cash for $6,000 and premium expense for $6,000 and credit premium inventory for $12,000. They would remove the $6,000 mixing bowls from inventory and ship them to the customers. To record the remaining premium expense for 2020, Fluffy would need to first determine the amount. Fluffy sold 300,000 boxes of cake mix. They expect 60% of the box tops to be redeemed, which would be 180,000 box tops. The total cost of the premiums would be $18,000. This is calculated by dividing the number of box tops by 10 and then multiplying by $1. Fluffy has already had $6,000 of premium expense recorded in 2020, so the remaining premium expense they expect to have in the future would be $12,000. To record this entry, Fluffy would debit premium expense and credit premium liability for $12,000. Another potential loss contingency comes from environmental liabilities. Companies are required to make repairs to the environment that result from their operations, and these are called asset retirement obligations. The asset retirement obligations are not normally current liabilities. Therefore, GAAP requires that asset retirement obligations are recorded at their fair value. This slide shows some of the common situations that may create an asset retirement obligation. As you might guess, these liabilities may be large, which is why it is important that they are recorded at the time that the asset is put into operation, so that the cost of the environmental remediation or closure costs are matched with the revenues that the assets generate over their useful life. To illustrate the recording of an asset retirement obligation, we look at the case of Wildcat Oil Company that erected an oil platform in the Gulf of Mexico on January 1, 2020. Wildcat is legally required to dismantle and remove the platform at the end of its useful life, which is estimated to be 5 years. Wildcat estimates that dismantling and removing the platform in 5 years will cost $1 million. Based on a 10% discount rate, the fair value or present value of the retirement obligation is estimated to be $620,920. To record the asset retirement obligation, Wildcat Oil Company would debit drilling platform, the asset, and credit asset retirement obligation, a liability, for the $620,920. To record the depreciation expense on the asset retirement obligation using the straight line method, Wildcat would divide the total cost, $620,920, by 5, the useful life of the platform, and record 1/5 of the expense each year. The journal entry would be a debit to depreciation expense and a credit to accumulated depreciation plant assets for $124,184, or 1/5 of the $620,920. The company would record this same amount each of the 5 years. Wildcat would also need to record an adjusting entry at the end of the year for the interest expense associated with the asset retirement obligation. Since the discount rate was 10%, the first year the interest expense would be $62,092, or 10% of the $620,920 carrying value of the asset retirement obligation. The journal entry would be a debit to interest expense and a credit to asset retirement obligation for $62,092. Each year after this, Wildcat would multiply 10% times the carrying value of the asset retirement obligation, which would increase. At the end of the 5 years, the asset retirement obligation would be equal to $1 million, the amount that Wildcat originally estimated for the removal and dismantling costs for the platform. On January 10, 2025, Wildcat contracted with Reclaimers, Inc. to dismantle the platform at a contract price of $995,000. To record the entry, Wildcat would debit asset retirement obligation for $1 million and credit gain on settlement of asset retirement obligation for $5,000 and cash for $995,000. It is important to note that self-insurance is really not insurance but risk assumption on the part of the company. Instead of buying insurance from an insurance company to cover claims, the company pays the claims that they experience as they arise. If there is no past event, there is no justification for recording an expense and liability. As you remember from the definition that we discussed in the first presentation, a liability is a present obligation that is based on a past event. In the fourth learning objective, we will discuss how to present and analyze liabilities and contingencies. Usually, current liabilities are reported at the full maturity value because there is little difference between the present value and the maturity values. Companies may present their current liabilities in order of maturity, descending order of amount, or order of liquidation preference. This slide shows the current assets and liabilities for Best Buy for the years ending January 30th, 2016 and January 28, 2017. If a company excludes a short-term obligation from current liabilities because of refinancing, which we discussed in the first presentation, it is important that they provide adequate disclosure of the pertinent facts surrounding the financing agreement, including a general description, terms of any new obligation incurred or to be incurred, or the terms of any equity security issued or to be issued. Disclosure of contingency should include the nature of the contingency, as well as an estimate of the possible loss or range of loss, or a statement that an estimate cannot be made. As we discussed in a previous slide, the three contingencies shown must be disclosed even if the probability of loss is remote. Two of the most common ratios associated with current liabilities are the current ratio and the acid test or quick ratio. The difference between the two ratios is that the current ratio includes all current assets in the numerator, but the acid test ratio only includes the cash, short-term investments, and accounts receivable in the numerator. Thus, the acid test ratio is more stringent than the current ratio. This slide shows the current ratio and acid test ratios that were calculated for Best Buy based on the information that was previously provided. These are the quiz hints for Chapter 13. Please make sure that you have completed the homework prior to attempting the quiz. There are 2 problems in each quiz. You will only have 1 attempt and 30 minutes to complete the quiz. You need to submit your work prior to the expiration of the 30 minutes because Wiley Plus does not save your work. If you allow the time to expire, your work will not be saved and you will not receive any credit for the quiz. This slide shows the review information for the problems for Chapter 13 that will be included in your exam. This is the conclusion of the second part of the presentation for Chapter 13, Current Liabilities and Contingencies.